Thanks, Luca. So, today we're going to talk a little bit about green finance, and Luca just mentioned the long term, and somebody once said that in the long term everybody's dead. I feel like the long term is getting much shorter with climate change. But I'm not going to, spend a lot of time talking about the scary part. I think that will probably be covered by others. But I'm also not going to spend my time at the podium, if that's okay. I think I'll just invite the panelists up here, and we can sit and we can have a bit of a conversation. So if I could ask Daniel and Jennifer to come up. Let me introduce you. Sit anywhere. Let me just get the intros here. And if we can get the slide deck brought up, that'd be great. Thanks. So sitting to my left is Daniel Mina. Daniel Mina is a son of Tanzania, so he's very much at home here. He's the Associate Director of Housing Finance for Africa at the Terwilliger Center for Innovation and Shelter. He previously worked as the head of digital finance at the Financial Sector Deepening Trust for several years, as well as many other companies. And Jennifer Johnson, just next to him, is the Deputy Secretary General of the European Mortgage Federation and ECBC, the European Covered Bond Council. Thank you. And she's been doing that since 2002. She oversees the legal and economic affairs, valuation, and research and data committees. So she specializes in a range of mortgage-specific issues and has a deep understanding of mortgage finance from both the retail and the investment sides, as well as policy and regulation. So we have two people up here who are really able to talk to us about the situation of accessing green finance. And I think, one thing that I want to mention, and we seem to be in a bit of a nostalgic mood here, I think, because it's the 40th anniversary of AUHF, maybe because we had Maria talking about her 50 years in the sector, but I want to bring us back even a little bit further, if we could see the first slide. Oh, maybe I should introduce myself, if anybody doesn't know. My name is Patrick McAllister. I'm the Director of Financial Regulation and Policy at Habitat for Humanity's Terwilliger Center for Innovation and Shelter. The Terwilliger Center really is an innovation center where we focus on working with market actors. And myself and Daniel, we both work in the Housing Finance Systems team where we look specifically at financial markets. So, in 1860, we can go back just one. In 1860, Henry David Thoreau said, "What is the use of a house if you haven't got a tolerable planet to put it on?" Henry David Thoreau at that time was reflecting on the fact that at that time in America, people were beginning to build in a more consistent way, rather than having the vernacular housing that he would have been used to. People were starting to build standard houses. And he thought that this was wrong. He thought that we were losing our connection with nature by putting houses on top of the land and not building them within the natural context that he believed people were meant to live in. So this conversation has been going on for a very long time. And if we could get the next slide, it's evolved. So Luca was just talking about complexity. So this is a slide that just gives the overall landscape of climate finance in 2021 and 2022. So as you can see, nothing simple here. But I do want to point out that climate finance is real and it is happening. I was looking at some statistics, and sort of between 2014 and 2019, the increase in finance, in green finance that was available, didn't change that much. It grew at maybe 1% to 3% over all those years. And then post-COVID, it exploded. And it was, oh, thank you. And it started growing, and it's grown by 67% since 2022. So right today, we have quite a lot of green finance available in the market. And so we should be interested in how to access that. Most of this, and you can see, if I can get a pointer here. Yeah. Most of this money is going to mitigation. Is that a good thing or a bad thing? Anybody? Good? Bad? Who knows? What is it anyway? So most of the money is going to mitigation. Very little, you can see up here, is going towards adaptation. Only 63 billion of about close to 1.3 trillion is going towards adaptation. Arguably, lower income people need adaptation more than they need mitigation. And I don't know, maybe other people can argue with that. We can have that conversation. But what we can't argue with is the fact that almost all of the climate funding is going towards mitigation. So if you are looking for climate funding for adaptation, you're going to find yourself in a much more difficult conversation. The other thing I want to point out from this slide is just over here. These multilateral climate funds, which, I don't know about you, I thought that was the majority of green finance. It's only 3 billion out of that only about 3 billion out of the 1.3 trillion dollars available for climate comes from these multilateral climate funds. Is that number correct? Does anybody know? Because please tell me if you do. Because I went on the Global Climate Fund site and they said that they have financed over $8 billion of climate projects. So if the total is only 3 billion, but they say they financed 8 billion, something's wrong. And I think, I'm not here to pick on anybody, I'm just saying it's really, really a complex system. And sometimes we get lost in the complexity, and we probably need to bring it down for our own purposes to actual facilities and actual tools that we have available to access climate finance. And so that's what we're going to talk about today. Daniel and Jennifer both have examples here. I did want to point out, Jennifer, somebody said earlier that there is no such thing as a green mortgage. It made me very nervous because Jennifer's whole presentation is on green mortgages. So, but first we'll hear from Daniel, and then we'll have time at the end for Q&A.
Thanks, Patrick. Don't have to introduce. I think we did a good job on that. So yeah, I want to talk a bit on an exciting project we're exploring with our partners, SIGA. And it's really trying to. You had in the morning when we talked about the carbon markets in our cities. But also we've had that, for you to talk about, green, you need to talk 5 times. So how do we get to that situation? So we've partnered with SIGA to really explore in terms of, so how do our partners or actors within the construction, the value chain participate in the carbon markets? But also, out of those proceeds, can we use them to really try and address barriers that are within the green construction value chain? And hence, then we will put up a pilot to really build a carbon green project in Kenya. And why Kenya? Several aspects. Kenya has come up as a leader in the carbon market. It's a very, inclusive finance system, but also there's a lot of vibrant, green building material ecosystem that we found out when we started doing, the research. So I think this has been spoken, but in reality is, for a low-income household to go green comes as a premium. It's very expensive currently. Several factors, I don't have to go through them, but then some anecdotal evidence has shown. you want to go green, there's like 4% increase in terms of the cost compared to the traditional ways. Certification is expensive. I think it has been mentioned several since yesterday and today also. So build all of that and the cost of credit for the low-income households, it makes really for moving from the traditional to the green, particularly for the low-income households, being very expensive. But it doesn't have to be that way. So we're trying to explore, particularly on the construction piece, and simply because some of you are aware, construction sector contributes almost 39% of the CO2 emission. Yes, there are different, strategies to overcome that, but we picked particularly the circular construction materials. Thinking that if we start addressing particularly the construction sector, which is the largest emitter, we can actually start to, not just address the availability of green financing, but also try to, deal with environmental issues. So our project really will focus on the beginning, the early stage of the housing green value chain, whereby we will look at the producers of the green materials, but also the green construction practices, and hence then try to see how those players within that sector can start participating in the carbon market. So just let's talk in terms of the carbon market. For some of you who are aware, we have different types of market. We have the the voluntary carbon market, which is where we want to really try and tap in, whereby individuals and companies come to set the carbon credits. But also there's another one, the compliance, which is very strict, national and some international agreements. But also some of the categories of the carbon credits, which we will look into, the removal credits, particularly on the biochar technology, and start picking and seeing how that can really, help to participate in the carbon market. So we are trying to test different pathways with what we're trying to do in Kenya. So one pathway is, for the green building material, providers or suppliers to participate in the carbon market. And when they get revenues out of, the carbon credits, can they pass that revenue towards the value chain so that they can actually increase, the materials, but also try to make sure that it comes at a cost that either it's less or within the, the traditional cost of materials. And that goes directly to the MSMEs, and ultimately we presume that, with the reduction of the cost of the green materials within the value chain, ultimately the low-income household can benefit by having, even lower, green materials. Hoping that can really transform the behavior, as we had that, we have a behavior issue also to move to green. But then we believe trying to start tracking the cost aspect might really try to help. The other pathway we are trying to explore is, can the financial service providers participate in the carbon market? And if there are any proceeds out of that, can that then create incentive for green financing to the MSMEs and the low-income household? It doesn't mean that we can't see a pathway of financial institutions supporting the green building material suppliers, but then that's also something we're exploring, but that's an opportunity that I'll talk about in the coming slide. Some of the carbon offsetting methodologies that are there globally, that we try to look in different markets to say which ones can we start with to explore. We don't have to go through the developers here who are really experienced into these methodologies. But then we've picked three areas that we've seen in the Kenyan context. There's a bit of our partners that are working on this. One is the biochar concrete interlocking stabilized soil blocks and mycelium insulation. So we will try to explore developers out of these three areas to see now how they can start participating in the carbon markets, and what sort of revenues are coming out based on the current situation? Can it help to really start reducing the cost, of these materials as they move along the value chain? But then we are seeing also opportunities for the financial, service providers. This can help also expand, the opportunities for green lending, also participating. We've heard about, access to capital. Can the financial institution participate? Things like the green bonds, but also driving innovation. Can we bring, the low-income households, women into the, green building ecosystem or green financing ecosystem, and also tie that to, the SDGs. But also, it's an opportunity that if we see that there is, a business and, there is good participation of these, green material producers in the capital market. The other opportunities for the financial service providers to really fund, most of these you find are startups, so, and they're looking for capital. So how can we now bring in together also the financial service providers to support? Because then there's a business case from them participating in the capital market. So this is how we've designed the project. We're in 4 phases. We're in second phase. So the first one was really to look at the market, what are the actors, really helped us to pick the three areas of green that we're trying to explore. The second one is research. So we are trying to see now how can the revenues that come up from the carbon market, how can it now start helping addressing some of the barriers within the housing value chain. The third phase, which is later, will be now to secure the right partners. So we know some of the partners that are operating within those 3 areas of pick, but then getting the right partners, the financial service provider, to participate towards the last phase, which is designing and launching a green housing finance carbon project. So that is basically in phase 2. But we're really excited, and we're looking forward to having more partners to collaborate and explore this area, which is still new in our markets, but we see a lot of potential coming up. Thank you very much.
Thanks, Daniel. So maybe if I can just ask you to cover one thing just before we move on. So you talked about these 3 different types of materials that you're exploring. Maybe can you just very quickly walk us through, say, the mycelium insulation and what it would look like if that is successful? How do they get financing from the financial institution? What do they use it for? How does it reduce cost, if it reduces cost, or is there just a cost premium? Can you just kind of walk us through that a little bit?
So, so currently most of these are startups, it's new technologies, they're trying to innovate. So what we are trying to do is, one is, first of all, understand their business. Most of them, they have challenges of capital in terms of scaling, building their distribution. You find most of them are like in one location, their production is still very low. So we're trying to see how much do they need in terms of growth, but then also really understanding based on the methodologies, how they can participate in the carbon market, how much revenue that will come out, and based on that, and based on their current cost structures, will really help to reduce the cost of production or ultimately the cost of, the materials that they are selling towards them. But also we're trying to see the distribution. If you look at the pathways that I mentioned, we have the MSMEs that, that we expect them to be the distributors of this product. So most of these are still new, they don't have the distribution. So out of also the income that they can get from their carbon markets, can it also help with their distribution so that they can actually commercialize these products. So that's what we're trying to explore.
Great, thanks for that extra explanation. Okay, so now I think we'll move to green mortgages. Do they exist or do they not?
They do exist, but perhaps not in the volumes that we would like to see. particularly after 10 years of our efforts to mobilise the green mortgage market. So, and I'll touch upon over the next kind of, 10 minutes or so, the reasons for that, right? Thank you. The reasons for that. So, what I should explain, of course, there is a bit of a caveat. This is our very European experience I'm going to describe, right? And that comes with a caveat because, of course, we have very large mortgage markets in the EU. Across the EU 27, so we have 27 member states, the volume of outstanding mortgages amounts to about 7 trillion euros. If you add the UK, Norway and Iceland to that number, we reach something like 9 trillion euros. So we have, at least in theory, quite a lot to work with, right? And that was really very much the starting point. About 10 years ago, Luca and I in our offices in Belgium, we started to recognize, if you like, the calls for finance, right? How are we going to finance this transition? And it was very much the inherent link between buildings and mortgages that led us to, of course, conclude that mortgage lenders have transformative potential when it comes to funding or financing the transition, because they can bring energy efficiency considerations into the conversation with a borrower who wants to buy a property or who wants to wants to build a new property or wants to buy an existing property and renovate that property. So we really felt that the mortgage lender was kind of the linchpin in this very important discussion. So in a nutshell, what we've been trying to achieve over the last 10 years is a mobilization of the green mortgage market in support of the climate transition, with a focus on new construction, so energy efficient new buildings, and the renovation of existing buildings. We have a very old building stock in the EU, a very old inefficient building stock that requires significant levels of investment to renovate. And so that is, I suppose, in Europe where the focus lies primarily. We've been lucky enough over the last 10 years to rely on several rounds of funding from the European Union to support us in our endeavours. And what that has led to is a body of research, analysis, tools, mechanisms, networks. And it's also, I think, really important to say that we have, over all of this journey, really identified a kind of value chain. So the emphasis at the very, very beginning of this discussion, or this journey, was on the green mortgage product. What are we talking about? What is it? How do we define it? How do we standardize definitions, parameters? But over time, of course, it became clear that the product on its own would not achieve anything. You needed really a value chain of other providers around it. So we started to talk to property values. We started to talk to building energy performance specialists. We started to talk to measurement specialists, building energy performance measurement specialists. We started to consider what consumer demand was for this type of product and for energy efficiency renovation per se. And so that really, as I said, kind of gave rise to significant bodies of research, analysis, mechanisms, tools, etc., all of which are available on our website, and you can consult those. What it also did was give rise to a certain degree of best practice indications. And those are indications, I think, which are interesting takeaways for all of us, not just for us in Europe, but potentially for all markets, the emerging markets as well, and not just in the area of green mortgages. You know, these best practice indications have the potential to be useful and indicative in other contexts, in other green finance contexts as well. What I'll do is I'll talk. I'm doing it where I'm supposed to be pointing at. I pointed too much.
I pointed up there.
Okay, all right. What I want to do is just to kind of bring you up to speed where we are today. So our efforts to identify the value chain developed over time into efforts to deliver an ecosystem. So of course we recognize that you can identify value chain participants, you can identify the various cogs in the wheel, or the links in the chain, but actually you need to integrate them into an ecosystem of products, providers, services. And so the last couple of years have been very much focused on delivering the ecosystem, the energy efficient mortgage ecosystem, with the consumer at its heart, so with the potential borrower at its heart. On the 1st of October, we started a new EU-funded project which will take all of our efforts to date to the next level. And what you see here on the slide are the remaining areas, or the ongoing challenges, let's say, that have been identified over the last 10 years. And we believe that transformation in these areas can really unlock the full potential of mortgage finance in the EU, in support of the climate transition. And I'll briefly talk through them. The first is around de-risking energy efficiency investment. So despite all of the efforts, despite all of our efforts, and also regulatory and supervisory efforts, there is still a perception that energy efficiency investments are complicated and complex. We don't fully understand the risks. And so there is, to a certain degree, a kind of caution from the part of lenders to really invest in this area. And so what we're trying to achieve here are ways for banks, for lenders, mortgage lenders, to better understand the nature of these risks, to be able to quantify these risks and manage them, and if possible, minimize them. So we'll be looking at correlation analysis. When I say correlation analysis, I mean we will be further developing existing analysis into the correlation between building energy performance on the one hand and credit risk on the other hand, driven by probability of default and loss given default linked to the LTV of the property. So if we just spend one moment on the LTV related issue, essentially the basic premise is if you increase the energy efficiency of a building, you're increasing its value potentially. And so you're minimizing the credit risk, or you're reducing the credit risk for the lender. And that is an important consideration when it comes to capital requirements. So it means that it could be cheaper for the lender to lend this type of mortgage. We'll also be looking at scenario analysis. So we'll be trying to help lenders to understand the impact of current and future scenarios, climate events, on their loan books and their balance sheets. And the third element of this first point is climate insurance. So the idea is to see to what extent we can actually integrate into the green mortgage offering climate insurance, whether that be at the level of the property, so to protect against or to mitigate the risks linked to physical changes to the property. We'll also be looking at the possibility of integrating mortgage insurance or climate insurance into green mortgage products with a focus on the credit risk of the borrowers, the potential for the borrower to default on their repayments, but also potentially the contractor performing the renovation or the developer building the property. So this is a relatively new departure for us. We haven't looked at insurance in the past. It's recognised in the EU that there's a serious insurance gap, in climate insurance coverage, but extreme weather events are occurring more and more frequently in the EU as well. The second area, and this links to the V in the LTV, so I talked about the loan-to-value ratio. The V, therefore, is very, very important. So the idea is to work alongside property values to make sure that ESG factors are appropriately embedded and reflected in their property valuations, and that banks, in instructing their property valuers, are giving them the right instructions, telling them what they need to be looking for. And the basic premise here is that ESG factors can have positive impact on value. I talked about it, right? So if you're improving energy efficiency of a property, you're potentially increasing its value, but equally physical risks can negatively impact a collateral value. So the idea is to make sure that this negative and positive effect is being reflected and embedded in property valuations. So we'll be preparing checklists for valuers, for financial clients to instruct the valuers, education, training materials for property valuers on the ground. All of this will be open source, so all of this will be available in the public domain. So if anybody is interested in any of this, it will, over the next couple of years, become available. Third point here is around optimizing financial operating models with a focus on ESG. And what we mean by that is trying to embed within the mortgage lender, within the bank, ESG considerations at every level of the bank's operations. So to give you a few examples, we'll be looking to design a framework or blueprint to help them to define decarbonisation pathways for their loan and their bond portfolios. We'll also be further developing our energy efficient mortgage label. We have a label which is focused on labelling the green mortgage products that do exist in the EU. We also have a covered bond label, which labels covered bonds. Beneath both of them is a disclosure template. So we'll be making sure that the kind of information that banks are disclosing is fully aligned with regulatory and supervisory requirements, just to enhance transparency as much as we can. We'll also be making policy recommendations to the EU authorities, because over the last several years we've seen a very, very complex, interconnected landscape, if you like, emerge around sustainable finance in the EU, and inevitably there are gaps, there are overlaps, there are discrepancies. The framework is perhaps not as accommodative or supportive as it could be in unlocking the protection of private finance. So the idea is to try to identify those gaps, those overlaps, and work with regulatory and supervisory authorities to address those. Coordinating a robust renovation supply chain, it kind of says what it does on the tin. So the idea is to make sure that the renovation supply chain, or indeed the building supply chain, is robust, it's transparent, it's innovative, it's coordinated, it's well-skilled and well-resourced, so that the kind of building that's going on and the kind of renovation that's going on is actually delivering what it's promising and what it's actually expected to. And last but not least, the idea is to put consumers at the heart of the climate transition. And here we'll be relying on behavioral economists to help us with behavioral analysis. So to really understand what is it that consumers want, what don't they want, and how can banks use levers and nudges to have the right kind of conversations and therefore tease out the right kind of outcomes for the borrower. So that's a really important point. I'll just spend, if I can, Patrick, 2 more minutes highlighting a couple of other issues that I think are relevant for this audience. And I won't go into huge amounts of detail. I have slides that have the detail. I'm happy to share them with you, and there is also a report behind this. But as I said, what we identified over the last several years was there are certain ingredients, if you like, which can help to make a green mortgage cake, right? We've got the eggs, we've got the flour, we've got the sugar, etc. And so they are by no means a blueprint, for developing a green mortgage market. They're by no means limited to developing a green mortgage market, but they're nevertheless useful food for thought. And you see them here on the slide. So the first is, of course, understanding consumer awareness and demand. And best practice here would seem to suggest you need to know your customer. We've heard that, I think, over the last couple of days quite a lot. There's really an emphasis being placed on awareness-raising campaigns. And here, public subsidies can also help. So not public subsidies linked to the loan or the mortgage, but actually public subsidies linked to building energy performance measures. Data availability and access. I don't need to repeat what's been said several times today. Financial data, of course, is critical, but so is building energy performance data. If we can link financial data and building energy performance data, we can really understand the performance of the underlying loan. We can understand the performance of the building, potential impact on the building's valuation, and therefore the performance of the underlying loan. So data availability is crucial. Building certification, absolutely critical. Open source databases for banks to access. Green bond markets, again, we've talked a little bit about green bond markets. What we've seen in the EU is that it's really the green bond market and the green covered bond market that has driven developments on the mortgage side. It wasn't really the mortgage side that was super excited about greening finance, right, or financing green. It really came from the bond markets, who themselves were responding to investor appetite. So a green bond market, a deep, liquid and well-developed green bond market will, I think, be a really interesting and useful catalyst for developments on the mortgage side. And I already covered the optimizing the value chain point, right? It's about integrating partners, creating strategic partnerships, optimizing market interventions, training, making sure that everybody has the right information at the right time and are doing the best really they can. Regulatory framework, we have, as I said, seen a flurry of legislative and supervisory initiatives in the last several years in the EU around sustainable finance. We've seen definitely a move towards taxonomies, and this across other markets, ESG-related disclosures. We also see an emphasis being placed by central banks on decarbonising their own bond holdings, greening the collateral framework, and finally building energy performance legislation. We need good, solid building codes. We need codes which are fit for purpose. We don't need codes which have been imported or exported and they're not fit for purpose for climatic conditions or the nature of the building stock. So that's, again, really, really important. And we see a move towards minimum energy performance standards, again, mandatory certifications. And finally, public support actions. We've mentioned public subsidies. I think Mario said it's no good subsidising the mortgage. But what we do see developing are, support actions around building energy performance. And that that's where you really can work hand in hand, public and private sector, to leverage on each other's, financing potential, I would say, to achieve, more targeted and perhaps more effective outcomes. We measured these pillars, if you like, across certain global jurisdictions. We worked with Joe in Kenya, we worked with Chagamas in Malaysia, and we worked with our Japanese friends in Japan, the Housing Finance Agency. And we drew from this, some kind of state of play analysis. How do these markets measure up, if you like, in terms of these key pillars? And what we found was, of course, there's a different starting point for each of these jurisdictions, whether it be in stage of economic development, climatic conditions, the nature of the banking industry, the nature of the building stock. But we're all on the same journey. We're just at different stages, right? And the climate transition and green finance are priorities across all of those. You see here on the slide, there are broad similarities across many of the areas we analysed, and it's possible to derive best practice indications. And as I said, we have a report which summarises all of this, but it's in no way a kind of a celebration of how well we're doing in the EU, and how we can, share our best practice. On the contrary, there are so many really exciting initiatives taking place. I mean, the central bank in Malaysia, so far advanced. Japanese in Japan, building energy performance legislation was first introduced in the late 70s. So there is so much, I would say, best practice out there that we can learn from each other, and that's essentially what we're trying to do here, is really kind of promote this exchange of information and best practice. I think I'll stop there. I've probably spoken too long. I could speak for days and hours, or hours and days on this, but yeah, let me stop there.
Great, thanks, Jennifer. Maybe if I could just ask one follow-up question. So I was surprised, I don't know if anybody else was, I was surprised to hear you mention the gaps, the overlaps, and the inefficiencies.
Yeah.
Because in my perspective, trying to work in emerging markets, Europe has it covered. They've got this big taxonomy somewhere that everybody keeps talking to me about. And, it seems to me like those gaps, those overlaps, and those inefficiencies should sort of be dealt with the EU taxonomy. So can you explain why that's not the case?
Yeah, the EU taxonomy is vast and huge, and it was, I think, probably one of the first of its kind, right? So it was a little bit of an experiment. We worked, as did many, alongside the European Commission on this, but at the end of the day, it's a menu, right? It's a list of economically sustainable activities. The problem comes when you layer that over financing, for example. There are different categories of building criteria, but they're not particularly supportive of the development of, for example, renovation finance, right? There's a big emphasis placed on the 15% best in class in the taxonomy, which is arguably incentivizing banks to lend to the 15% best in class. But of course, it's not the 15% best in class which is going to address our climate transition urgencies, right? It's the existing building stock that we need to address. So, of course, the taxonomy is what it is, right? It's a green taxonomy. Maybe one day we'll have a yellow taxonomy for the transition activities. We don't have it yet. But the taxonomy is just, if you like, the kind of the tip of the iceberg. There are disclosure requirements. There are regulatory and supervisory expectations, which, when you layer them, produce an incredible, a vast amount of requirements, which are not necessarily very well coordinated, very well aligned. Now, you may imagine that that's something which is easy to address, but of course we have 27 member states that have to agree any changes, right? The European Union is a bit like a kind of oil tanker. That's not a very good analogy, but forgive me for that. But once it's moving, it's very difficult to change its course. But we feel we're at the beginning of a new mandate of the European Commission, we're at the beginning of a new mandate of the European Parliament, so we feel as if we have, the timing is right now to do this research so that we can help to shape implementation of this legislation in the best way. So we will, as I said, be doing analysis over the next couple of months and possibly into next year around identifying these duplications and these gaps and trying to make the frameworks as supportive as possible. So I don't think we have it all made. I think if you want to look at really successful taxonomies, look at Singapore, for example. Singapore has a very, very light touch taxonomy, but it's super efficient and effective. Singapore has done what they always do, right? They look around and they take the best. And I don't think that the EU taxonomy, I think it's been very, very important in raising the profile of of the agenda, but I don't think it's necessarily as efficient as it could be. So there's still work to be done there.
Thanks for that. That's a really interesting perspective. I think we have a few minutes for questions, or maybe not.
I really do want to carry on the discussion, but it's.
We haven't got them tomorrow. So if people want.
Because our roundtable tomorrow.
2:30 tomorrow, we can have them.
I did promise space for questions, but we've run out of time and our hard stop at the end of the day needs to be compromising other sessions. I'm so sorry. What I really liked though, your framing, Patrick, with that lovely flag of colors that are moving along, which shows all of this money that's there. And the two different ways in which the two of you in your own areas are looking to harness that towards affordable housing. In some ways, it's like a double ask. That we're promoting green and we're promoting sustainability and we're promoting affordable housing, and both of them come with anxieties on the part of the lenders and the investors and so on. So it strikes me that the thing that we really need for everyone is to be writing everything down, taking care of the data, making sure that you share what the actual consequences are of making these investments and the impact that that actually has. So, yeah, okay. Thank you so much.